Hey, how are y'all doing today? Um, Today's topic of discussion, as y'all know I do every week or two here, I drop a little bomb up here on YouTube and Facebook and share some thoughts and opinions, a little bit of insight based on experience I've had with working in politics and things like that. Um, this week we're going to talk about the Federal Reserve. The Federal Reserve Bank of the United States has come under a lot of scrutiny over the past couple of years as a direct result of the disastrous economic situation in the United States and, in fact, the world. Earlier today, a friend asked me if the Fed was going to be my next topic of discussion. Initially, I was like, nah, haven't really given it a lot of thought. But after really kind of going back and thinking about a couple of questions he had asked and where we're at economically in the United States right now as far as money, housing, jobs, all of that stuff, I was like, yeah, you know what, it's time. Time to talk about the Fed. Probably get me a lot of feedback from a lot of different corners of the political arena. But hey, here we go. So, the Federal Reserve System, commonly known as the Fed, is one of the most controversial entities in the United States, as well as around the world. The controversy is really not all that surprising when you think about the power that the Fed wields over the United States and international economies. A little bit of history of the Fed, and I'll move on to the pros and cons and my position on the centralized bank system here in the United States, which will become pretty evident by the end of this little chit-chat we're having here. And I know how y'all love it when you get a history lesson, plus my opinion and my mouth runner for a few minutes. So the origin of the Federal Reserve System goes all the way back to about 1913, 1914. Between 1870 and 1907, there were 21, 22, 23, 25 different financial panics of varying degrees, depending on which expert you want to read. The creation of the Federal Reserve Bank came around actually in 1913 in response to a severe financial panic in 1907. The Federal Reserve System was created to avoid the recurring financial crisis and the bank failures that had plagued the United States system up to 1907. Finally, the president at that time and Congress said, we've really got to step in and do something. One thing to keep in mind is that in 1907, in the United States, there were a couple hundred different forms of acceptable currency. You might go from one state to another state and not be able to use the dollars and cents that you were using in the state that you were living in. In the Southeast, actually, post Civil War, as most of you are aware, a lot of Confederate currency became worthless outside of that region. However, it was still acceptable there. It was only after that whole fiasco with splitting the country up and then putting it back together and stuff and coming up with common currency that we actually had a common currency, which is, for the most part, remained unchanged since about 1909 or 1910. After the Panic of 1907, some of the great industrialists at the time, such as J.P. Morgan, Mr. Chase, Vanderbilt, Rockefeller, Carnegie, all demanded that politicians put a central bank in place. Even some of the private bankers and smaller banks drew up their own plans to centralize banking in their region, but J.P. Morgan and Mr. Carnegie were adamant and did a lot of lobbying to have a centralized United States bank. In their vision of the Federal Reserve structure or the centralized bank, the central bank would be a banker's bank, a lender of absolute last resort. The Fed was to stand ready to make loans and provide liquidity to banks facing unexpected depositor withdrawals such as occurred in the Great Depression between 1932 and 1937. The largest obstacle to the central bank was the fear of centralized power by most Americans. Keep in mind that at the turn of the century, people were still around who knew people who fought in the American Revolution, and they had fought a long, hard battle in revolt against a king and that centralized form of government and centralized control. Because Americans then and now tend to be very suspicious and apprehensive about centralized power and moneyed interest, the resulting central bank, the Federal Reserve System, has a very decentralized structure. And that seems a little bit, hypocritical, if you will, because it's a centralized bank with a decentralized structure. It has a system of checks and balances in place, much like the federal government. The checks and balances are mirrored kind of by the checks and balances of the United States Constitution. When we look at the way that the Federal Reserve is set up, there are essentially three different facets of the Federal Reserve System. The first is the Federal Reserve Banks. There are 12 regional banks, each cover a region or a district of the United States. These banks serve the member banks that reside within that district or region. Every single national bank in this country must be a member of the Federal Reserve Bank. Membership is optional for state banks and local banks. About 1/3 of all commercial banks, such as Fifth Third, the old Bank One, Bank of America, things of that nature, are member banks by choice. The member banks are part owners of the district bank and they receive dividends. So the 12 regional banks ultimately are a hybrid of a government institution or agency and a private for-profit entity. Creates a lot of discussion, we'll say, about what their real function is. Is it to make money or is it to protect the economy? As of 1980, any depository institution, not just member banks, must keep reserve deposits with the Federal Reserve Bank in their district or region, and in return they have access to emergency loans, or discount loans they call them, from the district bank. The district banks are responsible for reviewing all of mergers and acquisitions by depository institutions in the district. They also play a role in monetary policy, setting the discount loan rate, and they also sit on the FOMC, which is the Federal Open Market Committee, which we'll discuss a little more in depth here in a few minutes, because it's ultimately the crux or the reason that the Fed exists. The Federal Reserve banks provide a lot of other services, member banks, check clearing, currency, collecting, and analyzing economic data. They are also the United States government's bank. They manage United States Treasury accounts and monitor the borrowings of the government in that region. The most important Federal Reserve Bank in the nation is the Federal Reserve Bank of New York. And the reason it's so important is it plays a very special role with foreign central banks, international currency exchanges, and the Federal Reserve open market operations that we'll talk about again here in just a few minutes. The Fed in New York is the bomb diggity. The chairman of that particular bank has an amazing amount of power internationally. He or she, as the case may be, really has a very, very strong hand in what goes on around the world economically. So keep that in mind as we walk through the rest of this, okay? New York, really is the financial place of the world. The second facet of the structure of the Federal Reserve is the Board of Governors, or the BOG. At the top of the Fed are seven governors, and they are appointed by the sitting United States President, and they must then be confirmed by the United States Congress. Their appointments last for 14 years, and they are not renewable. You cannot be reappointed to the Federal Reserve Board of Governors once you've been there. The longer term than most politicians or political appointees have gives some measure of political independence, although that's kind of controversial too, to the decisions. Ideally, because they hold office longer, they aren't as apt to make short-term decisions. One governor is appointed by the president to serve as the chairman of the Fed for a 4-year renewable term. For example, if you were appointed to the Federal Reserve by the president, confirmed by Congress, you would be there for 14 years. However, if the president decides to appoint you as the chairman of the Fed, you serve for 4 years at a time, just like the president, and you may be reappointed over and over and over. There is absolutely no term limit to sit as the chair. The current chair is Ben Bernanke, who has served since 2006. He replaced somebody that probably most of you remember, Alan Greenspan. Alan Greenspan served from 1987 to 2006. He was appointed by many presidents during that time. Mr. Bernanke, the current chair, reports to Congress twice a year and is viewed internationally as the second most powerful man in the United States, as well as the second most powerful individual in the world. Extreme amount of power over all things money, both domestically and internationally. The Fed board is very important in setting monetary policy. All 7 members sit on the Federal Open Market Committee. As I said, we'll discuss that a little bit later. The board sets reserve requirements and approves the discount loan rate in each district. So they control the interest rate that the banks are getting from them. The board, with an absolutely huge staff of economists, conducts a large amount of data collection and economic research. They also have many regulatory functions with respect to financial institutions and markets. It has the final say in bank mergers, permissible activities, setting policy and procedure and guidelines, and lobbying for new laws. The third facet of the Federal Reserve structure is in fact the Federal Open Market Committee, or the FOMC. The real influence on the economy comes from this committee. This committee has 12 voting members, which includes all 7 governors, the president of the Federal Reserve Bank of New York, and 4 of the other regional bank presidents on a rotating basis. The committee meets every 6 weeks without fail, and they meet more frequently if there's an emergency such as 9/11, major disasters like Hurricane Katrina, the tornadoes in the southeast earlier this year, etc. When they meet, they assess the condition of the economy, and they vote on monetary policy for the coming weeks to ensure that such disasters don't create panic and everybody rips all their money out of the bank, things of that nature. They vote on all open market operation. That means they're buying and selling of treasury securities and financial markets, both domestically and internationally. In doing so, they control the federal funds rate, which is somewhat controversial, no matter how you look at it. Essentially what that does is it dictates the rate that the banks charge each other for interbank loaning, or lending, excuse me. This is the most important policy tool of the Fed. At each meeting, current economic conditions and forecasts are presented, policy options debated, and then they vote. The vote is actually for federal funds rate target to be achieved through open market operations. So they sit down and say, okay, we want to achieve a rate of, boom, 5, we'll say. How are we going to do it? What finances do we need to manipulate nationally to allow us to hit that number? They also decide on federal funds rate target. Achieving this target through open market operations is the job of the Federal Reserve Bank of New York. That's how we kind of have a direct impact on the international economy. We're kind of going to look at the structure, because the biggest controversy with the Fed is whether they should remain independent or not. As I previously mentioned, they are a hybrid. They are very definitely a for-profit organization operating as a government entity, which creates lots of wishy-washy gray areas. So, kind of going to look at the structure and then look at the pros and the cons. The structure and financing of the Fed give it considerable independence from political pressures. As I mentioned before, the Fed governors serve 14-year non-renewable staggered terms. These long terms give them some measure of political independence in their decisions because they typically hold office along with the president that appoints them. Further, when the chairman is very popular within the financial sector, such as Alan Greenspan was, the president will be under a huge amount of pressure to reappoint him, even though he may not be from the same political party. Alan Greenspan was appointed and reappointed 5 times by 4 different presidents, both Democratic and Republican. More important for the Fed independence is the source of its financing. Most federal agencies, the Post Office, Department of Health and Human Services, Department of Education, Department of Homeland Security, all of them depend on Congress to give them money to operate. Because of the unique existence, I'm going to say, or structure of the Federal Reserve System, the Fed funds its own operations through the profits that it makes from trading and holding Treasury securities and through revenue from discount loans. The Fed made about $60 billion profit last year, some of which was actually returned to the Treasury following the bailout. This means the Federal Reserve System does not depend on Congress for funding and therefore doesn't really have to listen to what they say. This lack of control by Congress and other politicians gives the Fed considerable freedom to make decisions on its own. Of course, important to remember here is that Congress and the President do retain ultimate control. The Office of the President and the United States Congress could pass laws limiting Fed power or redefining what they can and may not do. The Chairman of the Board of Governors must report to Congress twice a year about its economic goals for monetary policy. But in the end, Congress or the President cannot tell the FOMC what monetary policy to pursue. So this committee decides what it's going to look at and what it's not going to look at. Central bank independence may seem democratic to some, but it's not a unique idea. In fact, all industrialized countries give their central banks some degree of independence, including the European Central Bank, Germany, Switzerland, and much more recently Canada, England, and Japan. Given the Fed's independence, the question looms, is independence a good thing? Those who support independence basically maintain that their argument for independence is the notion that political goals are short-term and economic goals tend to be more long-term. While Congress might be tempted to use monetary policy to maximize re-election attempts, An independent Fed is free to pursue policy that promotes long-term economic goals, development, and growth, even if at the time they're unpopular. An example of this is the economic goal of low inflation or price stability. In order to control inflation, the Fed may need to pursue policies that actually slow down the economy and increase unemployment. While this will be painful and extremely unpopular in the short term, it will cause politicians a great deal of grief. It will lead to a greater economic growth in the long run. If you recall, 1981 and 1982, the Fed, under Chairman Paul Volcker, actually contributed to, and some believe caused, a severe recession in an effort to bring down a very high inflation rate. Yet today, many economists credit him for the long-term economic expansion of the 80s and 90s, which occurred long after he had left office. No elected politician would ever deliberately cause a recession, no matter what the long-term benefits may be according to their data gatherers and economists, because they need to run for re-election. Federal Reserve folks, not so much. When we look at the flip side of this, the argument against allowing the Federal Reserve's system to remain independent, it's undemocratic. It allows the Fed to be accountable to absolutely no one if they do a crappy job. Voters can get rid of a bad senator, a bad representative, a bad mayor, even a bad president, but they're stuck with a board of governors for 14 years. They have absolutely no input whatsoever into who the leaders of the Federal Reserve System are. Furthermore, there are historical examples where the Fed, despite its independence, failed in its responsibilities. The bank failures of the Great Depression are a prime example, as is the current economic situation that we have found ourselves in. If you think about this, it's because of the Federal Reserve banks that certain banks recently were declared too big to fail. We rely on them too heavily to allow them to go under, so we're going to take money from you to make sure they stay up. Most of the debate about financial reform has focused on the Goldman Sachs, Lehman cases, and how to deal with failing institutions and what really constitutes too big to fail. These are all important issues, okay? There's a current movement on in Washington, D.C. in the Congress to kind of pull back that mystical curtain that the Federal Reserve is shrouded in. Over the last couple of years, we've learned a lot about the shadow banking system that helped bring down the economy, and we blame it a lot on the small banks and credit unions and things like that. However, no entity has been more central to the failure of regulation that helped create this crisis, nor more central to keeping solvent the banks that enabled it than the Federal Reserve System. Through guarantees, equity investment, debt purchases, and other methods, the Fed's probably spent upward of $2 trillion to resuscitate the banking system. Remarkably, at a time when transparency and disclosure is on the lips of every politician running for re-election and election, it still remains really, really unclear how transparency and disclosure applies to the Fed. We don't even know which banks got how much because they're not required to disclose anything to us. Given the huge amounts of money and the unusual nature of the Fed's activities, especially in contrast to its historical and more prosaic role of controlling monetary policy, there have been calls for greater transparency at the Fed. One proposal, which varies in details depending on which party is advancing it, would essentially extend the authority of the Government Accountability Office, or the GAO, to cover the Fed. In essence, the Government Accountability Office would be able to audit the Fed. This is true. That's why the GAO exists, is to audit all federal agencies. As I mentioned earlier, the Fed is a hybrid of a federal entity combined with a very, very for-profit organization. Creates a lot of, like I said, wishy-washy areas with laws governing them, and they truly are accountable to nobody. There are a lot of reasons to require greater transparency at the Fed. One of it is conflict-ridden governance structure. And there's a huge tangled web of contradictions surrounding the bailout and things like that nobody knows what really happened to those trillions of dollars. Last but most important is that the Fed over the course of the crisis has demonstrated that its influence goes far beyond the issue of monetary policy. The influence of the Fed, as I mentioned earlier in this discussion, goes international. And as far as monetary policy goes, controlling the supply of money, the Fed is constrained by reasonably well-understood policy levers that have impact. The decisions are rather evident in very short order. Now, in contrast, right now, what the Fed is engaging is fiscal policy, spending money. That's not their job. They have become the largest fiscal actor in the United States economy, dispensing hundreds of billions of dollars to private parties. In doing so, the Fed is picking winners and losers. Why did they pick to help Goldman Sachs out, but not Lehman? Why guarantee the debt of some companies, but not others? They have such enormous discretion in the decisions they make and absolutely no accountability that it raises a lot of questions for me. It is entirely appropriate to demand that they be carried out, or that they carry out their decision making in a transparent manner like we require of other government agencies. Can you imagine the Department of Veterans Affairs not being transparent on how they're spending their money? Probably not. Probably not. Not surprisingly, the chairman of the Fed, Mr. Bernanke, and Treasury Secretary Timothy Geithner are pushing back. Put aside for a moment Geithner's apparent conflict of interest here, because any oversight would presumably examine many of his decisions as president of the New York Federal Bank, which we discussed earlier is the most important component of the Federal Reserve System in the United States. Take him at his word, which is that subjecting the Fed to any oversight would create a risk of politicization and loss of integrity and independence. I think it's already lost. How many of us really trust the Fed at this point, knowing what we know about the bailout and things of that? Reality says it is just the opposite. The very fact that the actions of the Fed are shrouded in such deep, dark secrecy is what has created the impression that politics have in fact driven the decisions of the Fed. The old maxim that sunlight is the best disinfectant is no less true for the Fed than it is for any other public government entity. Indeed, recently revealed evidence helps prove that out. In 2004, former Fed Chairman Alan Greenspan sought to keep from the public internal warnings of a housing bubble, or indeed any of the board's decisions. They absolutely sealed every record from the Fed that year. He said, "We run the risk by laying out the pros and cons of a particular argument of inducing people to join on the debate." Isn't that what our country is about? Letting all of us have some input into the debates going on that impact us as citizens of this country? He went on to say, and in this regard it is possible to lose control of a process that only we fully understand. Certainly people outside this bank could not possibly get what we're doing. What more proof do you need? I mean, here's the proof that we need anything at all, that the suppression of information about the logic behind the Fed actions have disastrous consequences. Had that dissenting point of view been made public, then the groupthink mentality that runs the gambit here in the United States and overtook most of the regulatory and banking communities might have been shaken a little bit, preventing the creation of these super banks that would be deemed later too big to fail. The Federal Reserve is seeking now to acquire additional powers as the reform of the financial and fiscal systems in the United States moves forward. The most important request it's making is that it seems to be seeks to be first among equals as the systemic risk regulator, serving as the early warning system for future debt shocks that will most inevitably arise. Yet at the same time, it seeks to avoid even minimal scrutiny of its past performance. Can we trust them to be the blower of the horn, so to speak, when they failed us so miserably this time? It doesn't make sense to me. It seems like a pretty simple trade for Congress to negotiate. You guys over there at the Fed want some more power? You want us to trust you again, even after making some of the worst decisions in our financial history over the past decade? Okay. Help us understand what you do and how you do it. Let the sun in, come out of the shadows, and show all of us how the decisions you make are made. Be transparent. Show us what our money really goes for and how our economy is regulated. And with that, I'll wrap this up. I think you pretty much know where I stand. I'm not sure that I can give any really viable argument for keeping the Fed shrouded in secrecy like it has been since its creation in 1913. I think that it is time that our financial reform include reforming the Federal Reserve structure in this country and perhaps spreading out some of the power that they have. Certainly taking power away from 7 people who have the ability to totally destroy the United States economy and to totally bring the international economy down. With that said, I will let you all go. Any questions, comments, concerns? hit me here on YouTube or Facebook. Thanks, and have a great day.